Tesla spent a decade building the electric vehicle market from nothing. Now it's being beaten by a Chinese company most Americans have never heard of, not because Tesla failed, but because it succeeded too well. By proving electric vehicles could work, Tesla validated an entire industry. That validation attracted hundreds of billions in investment and forced every automaker to compete. Tesla built the market, then watched it grow beyond its control. This is the story of how Tesla lost control of the market it created, not through failure, but through success. Between 2018 and 2021, Tesla didn't just lead the US electric vehicle market, it defined the market. At its peak, Tesla captured nearly 70% of all EV sales in America. In some quarters, it outsold every other manufacturer combined. Globally, by 2020, Tesla accounted for roughly 1/4 of all battery electric vehicle sales, despite offering just 3 mainstream models. Tesla's financials showed it. While traditional automakers struggled to hit 10% gross margins on their EVs, Tesla was achieving over 25% by 2021, margins that looked more like a luxury brand than a car manufacturer. That gap wasn't accounting magic, that was pricing power. Tesla could charge what it wanted because buyers had nowhere else to go. The reasons for Tesla's dominance were structural. When most people worried their EV would die on the highway, Tesla had already built thousands of supercharger stations across the country. When legacy automakers were outsourcing batteries and relying on dealer networks that didn't want to sell EVs, Tesla controlled everything: the battery technology, the software, the manufacturing, the sales experience. That vertical integration meant faster iteration, lower costs, and direct relationships with customers. In a small, early adopter market where infrastructure was scarce and competition limited, these advantages compounded into something close to a monopoly. Tesla's dominance rested on a specific set of conditions: EVs as a niche product, limited competition, and high barriers to entry. Over the past 3 years, all of those conditions evaporated. By 2024, electric vehicles crossed 10% of new car sales in the United States. At 10% penetration, EVs enter the shopping list for average buyers, not just tech enthusiasts and climate activists. Dealers start taking them seriously, service networks expand, the used market develops. That transition fundamentally changes what matters. Early adopters will pay a premium for innovation, tolerate limited model choice, and overlook rough edges. In contrast, mainstream buyers compare prices obsessively. They want options across every size and price point. They care whether their neighbour got a better deal last month. Effectively, the market became price sensitive. The global picture was even more pronounced. In China, the world's largest car market, EVs hit nearly 50% of new car sales by 2024. In Europe, 1 in 5 new cars sold was electric. At that scale, EVs started behaving less like experimental technology and more like refrigerators, a manufacturing game won by whoever can produce the most units at the lowest cost. And here's the problem for Tesla: none of its early advantages were built for that kind of market. You can see exactly when Tesla lost control by watching what it did with prices. Starting in early 2023, Tesla began cutting prices, aggressively and repeatedly. The Model 3 and Model Y saw reductions of 20 to 30% in some markets. For example, a Model Y that cost $65,000 in late 2022 was selling for under $47,000 by mid-2023. On the surface, Tesla framed this as strategic, lowering prices to drive volume, leveraging scale, staying ahead of competition. But price cuts of that magnitude tell a different story. Companies with true pricing power don't slash prices by a third in 12 months. What Tesla was really doing was defending market share in a market it no longer controlled. The strategy worked, sort of. Deliveries stayed strong. But the margins took a hit. Tesla's automotive gross margins fell from the mid-20% range to around 18% by 2024. Still healthy by industry standards, but the trajectory was unmistakable. Tesla was converging toward everyone else. Meanwhile, the company's market share kept falling. In the US, Tesla's share of EV sales dropped from around 60% in 2020 to under 40% by late 2024, even as the total addressable EV market in the US grew. Globally, the slide was steeper. Dozens of new models from established brands flooded the market. Hyundai's Ioniq line, Rivian's trucks, BMW's electric SUVs, Mercedes' EQ series. But the real threat wasn't coming from Detroit or Munich. It was coming from Shenzhen. In early 2025, a milestone passed with little fanfare in the US media. BYD overtook Tesla as the world's largest seller of battery electric vehicles. If you haven't heard of BYD, you're not alone. It barely sells cars in America. But that irrelevance won't last much longer, and what BYD represents reveals everything about where the EV market is heading. BYD didn't beat Tesla by being more innovative or more exciting. It beat Tesla by being optimized for ruthless, high-volume, cost-driven manufacturing, at a scale Tesla has never achieved. Look at the numbers. In 2024, BYD sold approximately 4.27 million EVs globally, which is more than double Tesla's total output. One of its mega factories in China produced over 1 million vehicles in a single year. By comparison, Tesla's most productive factory in Shanghai makes around 950,000 annually. But volume alone doesn't explain it. What makes BYD dangerous is vertical integration that goes far deeper than Tesla's. Tesla controls its battery technology, software, and assembly. BYD controls the lithium mines, the battery chemistry, the semiconductors, the motors, the power electronics, virtually every component. It even owns the ships that transport its cars. This is the playbook for mature markets. Control everything, eliminate supplier margins, operate at scale, and compete on price. And it's working. By 2024, BYD commanded roughly 22% of the global EV market. Tesla had around 10%, but that gap keeps widening. Here's what matters. BYD isn't an outlier. The market has shifted toward manufacturers built for cost efficiency and industrial scale, and Tesla's innovation-first model, the model that won the early market, has become a structural disadvantage. Tesla built the market, but markets once built don't stay controlled by their founders. IBM dominated mainframes, then lost the PC era. Netscape pioneered browsers, then got obliterated. BlackBerry created smartphones, then watched Apple and Google take over.